All right. Well, I'm going to run through some cattle market update for a few minutes here. Obviously, we're in a very, very unprecedented time in cattle markets in the U.S. We've set new record prices just about every week for the last several weeks for just about all classes of cattle. So I'll quickly run through just kind of an update. Now, these are Southern Plains basis prices, so there'll be a little bit of an adjustment. The pattern for you will be certainly very similar. So calf prices, again, you can see we've been higher year over year, each year really for the last two years plus this year. Feeder cattle, same story for the most part. We continue to run up to new record levels. Fed cattle market has really exploded in the last 3 or 4 weeks in particular. I mean, it's really following the trend that's been in place for quite some time. And so these are live basis. You're probably a little more familiar perhaps with carcass-based pricing, but these are live-based prices for there. So if you put all of these together, this chart probably really puts the best perspective on sort of where we are and a little bit of how we got here. Obviously, before we're done, we're going to try to talk about where we go from here. But so this chart shows about 15 years of prices. The blue line is a calf price. The green line is a big feeder cattle. And the red line is fed cattle. And so obviously on the far right-hand side, this is where we are now. This run up really started in late 2022 and has continued pretty much with just some minor setbacks. Obviously, we're in pretty volatile times and we're subject to a lot of short-term volatility, but these markets are very resilient and have continued to move up. And again, the obvious question from producers is, where's the top? Are we near the top? And what does the backside of this thing look like? Obviously, there's a comparison to what happened about a decade ago. We saw something similar for somewhat similar reasons. That was drought force liquidation that took cattle numbers lower than we planned for them to. That's what's happened this time as well. So there's some similarities, but there's also some pretty important differences this time. And one of the differences I'm going to tell you now, and then I'll come back and try to reinforce why later. But the previous peak that we saw about a decade ago was pretty short-lived. We managed to really increase cattle numbers and beef production very quickly and sort of tear up our playhouse, if you will. This time, it looks to be very different. I think it's going to be a much more sustained plateau of elevated prices, and we're not at the top yet based on other numbers that we'll look at here. Just one more market, just to kind of put it in context. These are our cull cow prices or slaughter cow prices. Obviously, cow slaughter has been way down the last couple of years, and these prices continue to levels that we've just not seen. We've moved up every year for the last, this is the 5th year of higher cull cow prices. The main driver for all of this is of course, where we are with cattle inventory. So the beef cow herd on January 1 of 2025 was the smallest since 1961. And in fact, we're smaller by about 1.1 million head than we were a decade ago at the previous low. And of course, the industry tends to be cyclical. We have these cycles of inventory, but the last two have been exaggerated lows because of lows in inventory because of drought conditions. And so we're smaller than we intended to be. We're smaller, I think, than the market wants us to be based on the prices that we're seeing and the incentives that the market's trying to provide. And yet, as of yet, we haven't changed things. In fact, one of the questions is the current low for 2025 the low for this cattle cycle? And the short answer is maybe, but we don't really know for sure. I think 2025 is going to be kind of a sideways move in inventories, possibly slightly higher, so we can call the current low the cyclical low, but it won't grow much, if any, this year based on the numbers that we're working with. Biggest reason why we are where we are and why it's not turning very fast is where we are with our replacement heifers. I'm going to come back at the end and really talk about what it takes to put together a herd rebuilding But the short answer is we've been liquidating our replacement heifer inventory for a number of years. And so we're starting with extremely low inventories, and it's going to take time to replenish those. We got here because of drought. Some parts of the country started in drought actually in 2020, but 2021, 22, 23, 24 were all drought years somewhere. And that's one of the differences this time compared to 2011, 12, and 13, which set up the previous record prices, because that drought was much more regionally concentrated. It was really right down here where I'm at in Oklahoma and Texas. We had extremely severe drought in 2011 and 2012 that caused liquidation, but some parts of the country were not much affected by drought at that time, and they continued to behave and operate differently, which set us up for a faster recovery. This time, pretty much everybody has had a turn in the barrel. And, the latest drought map that came out yesterday shows that now the Southern Plains is vastly improved. We've had enormous amounts of rain in the last 2 months, 7 or 8 weeks. We went from being deficit in moisture in Oklahoma to having about a 10-inch surplus recently. So we've seen a big change, and that will impact what we're trying to do in this part of the country. But there's still a lot of drought and drought threats from Nebraska northward in the central and northern plains, and obviously even some drought conditions that extend over into northern Indiana, where you're at, close to it. And so we've still got plenty of drought threats that will be a limiting factor for at least some folks in the country. The drought outlook from the Climate Prediction Center, this is the last one. They'll be doing another one here in just a few days, but really reinforces the idea that the northern part of the country is likely to stay dry. We may see some additional drought development in the central and northern plains in addition to what's already in place. So again, plenty of threats that provide caution for producers in those regions in terms of any plans they have and their ability and willingness to be sort of aggressive about restocking or rebuilding given these conditions. Just a sentence or two on corn on feed markets. I won't spend much time on it. Obviously, you're right there in the middle of all of this, but the corn market has been, from a feed standpoint, come down significantly since 2023. And has been operating in a very, sideways kind of pattern. At this point in time, I think the prospects for this year's corn crop look relatively good, but it could change. There's a long time to go yet. But unless something dramatic happens, I don't foresee feed prices coming in from a livestock perspective, especially a cattle feeding perspective. This is Kansas feedlot data that I have access to. And again, from the peak in 2023, feedlot cost of gain worked its way lower with the big crops in 2023 and 2024. And so we find ourselves now with a cost of gain that's substantially more favorable for feedlots compared to what they were working with just a couple of years ago. So that has been a really saving grace for feedlots. Feedlots have been able to largely maintain profitability up to this point. Now, I do think they have some real challenges ahead. One of the issues is, and I'm going to talk about feedlot numbers in just a second, but one of the challenges going forward, of course, is the fact that the feeder cattle are so high. And this chart just shows the current difference between feeder cattle and fed cattle prices, and that's about as wide a spread as we ever see. So, so a longer term average would be more like the red line. We're up here with extremely wide spreads. And if you remember that earlier chart when I had calves, feeders, and fed on the same chart, as prices go up, those lines get farther apart, which is another way of saying that the lighter weight animals at every level are going up farther and faster than the next level up. And so for feedlots, that means that the cost of feeder cattle, replacement feeder cattle for placement in the feedlots is getting more and more tricky, and overall numbers, tight supplies of feeder cattle is going to be a real challenge going forward for feedlots. Now, feedlots have been able for about almost 18 months now to be able to hold inventories pretty steady, despite the fact that feeder cattle supplies are generally tighter. The calf crop actually peaked in 2018 and has gotten smaller every year since then for the last 6 years. And yet feedlots have been able to hold inventories through a couple of things that they've done. You know, I think their bag of tricks is about empty. Currently, we're about 2% down on feedlots year over year. We'll get the June cattle on feed report in another week or so, and I expect it to stay similar to that. I do really think that these feedlot inventories are going to start coming down faster in the next few months compared to what they have in the past. If you look at this chart, these are average placements in the blue line and average feedlot marketings in the red line, and they've both been declining generally. And that's consistent with the fact that the calf crop, as I said, has been declining for the last 6 years. There's less feeder cattle in the country, but feedlots have been able to hold inventories much more flat. You can see that here with this green average line. Feedlots, after declining from the peak in 2022, for the last 18 months, feedlots have been able to hold the average inventory pretty flat. And they've done that with a couple of reasons that probably won't continue to be possible for them. If you look at where we were 10 years ago, we have not dropped anywhere near like that yet in the feedlots, but I do think it's coming. I do think we're going to see feedlot inventories drop probably at least 1 million head on average in the coming months. Now, I have to be honest, I expected it a year ago, and they've been able to hold it off up until now. But again, I don't think their ability to do that going forward will be there for them. You know, there's a couple of reasons why feedlots have maintained bigger inventories. The biggest one, or one of the biggest ones, is that we've continued to feed a lot of heifers. And so this chart shows the heifers as a percent of total feedlot inventories. We've been up here above average, you know, since about 2019. And we did see a decline in the April quarterly data to the lowest level in the last 5 years. So I think maybe it's coming down. There's been a couple of head fakes over the last year or two that didn't turn out to be a trend. But we'll see. Come July, we'll get another update of this. And if this line continues to come down, then it's going to be more consistent with the idea that maybe we are beginning to retain some heifers and think about herd rebuilding. Again, if you look at what happened a decade ago, that heifer on feed percentage dropped down here into the low 30% range, 32, 33%. I would expect that we need to go down somewhere close to that range in the next few months to, you know, a year, if in fact we're starting to retain some heifers and think about putting a low in these cyclical inventories. The other reason that feedlots have been able to hold inventories is because they've slowed down the turnover rate. There are, in fact, less cattle coming in. That placement chart showed that. But over the last 15 months or so, in particular, maybe 18 months, feedlots have really slowed down the rate of turnover. That is to say, they've added days on feed. So we're taking these cattle, there's fewer of them coming in, but we're holding on to them longer. And so we can sort of keep the feedlot full with less cattle coming in, just because we're not moving them out as fast as well. That works as long as you're slowing them down. But when you stop, once you get them slowed down and you stop slowing down, then the reality of the smaller feeder supplies are going to catch up with you. This is that Kansas feedlot data again, and it looks like days on feed sort of maxed out here 3 or 4 months ago, and will begin to has begun to come down. Now, I don't know that it'll come down dramatically, but it probably means that we won't continue to slow down the feedlot turnover rate. Obviously, if you add days on feed in the feedlot, carcasses get bigger. And so we've seen a tremendous jump in carcass weights. This is just steers, but heifers is the same. 2024, we had about a 21 or 2 pound annual average increase in steer carcass weights in the country. That's a really big jump for 1 year. And we're still heavier this year, and we will probably stay heavier, but I don't think we're gonna increase that annual carcass weight as fast as we have. Again, we've probably about maxed that out as well. And it's behaving a little bit more seasonally. Normally, carcass weights come down to about this point in the year, and then they go up in the second half of the year. Last year, they did not decline much at all seasonally, but they are showing at least some decline this year. So it sort of says that maybe they're acting a little more seasonally. Here's a longer term chart to see what we've done. And you can see over the last 15, 18 months, we have significantly increased the average carcass weight. And this is a moving average. So this is fully a trend, not just seasonal patterns. And we pushed these carcass weights to record levels and beyond, honestly, at this point. Just a little bit on grading. Grading percentage is good. One of the things this industry has done extremely well over the last 15 years or so is improved quality and consistency of our product. That, I think, is one of the keys to the beef demand we'll talk about briefly here in a second. But so, even though we've added a lot of days on feed, which tends to help grading, we really aren't seeing much improvement. The choice grade seems to have sort of plateaued out here. Choice grading, we have seen some continued increase in the prime grading percentage, and we're pretty consistently making 86% choice and better quality carcasses, which is, again, a significant improvement, certainly over several years time period, but driven in part now by the current market conditions. One of the other things that happens when you feed cattle more days on feed is they get a lot fatter. And so one of the things that's maybe not a positive necessarily, but understandable in the current market situation is that the percentage of yield grade 4 and 5 cattle in the industry has jumped pretty sharply in the last 18 months or so as well. So that's something that goes along with that slowdown in the turnover rate in feedlots and feeding those cattle more days. If we look at slaughter for a minute, so far this year, we've seen both steer and heifer slaughter begin to decline. So the total of fed slaughter is down about 2.4%. This is based on 21 weeks of data here in the first half of the year. Last year, for the whole year, we saw no decrease in fed slaughter. Steers were actually up slightly. Heifers were down just fractionally. And so that was one of the surprises last year, was we did not see fed slaughter decrease. Now, cow slaughter has been declining for 2 or 3 years. And that's, that market, that's really the ground beef market. That market has tightened up dramatically. But we haven't really seen that much change on the fed side, but in the last 7 or 8 weeks, fed slaughter has dropped between 5 and 6%, I think, on average. And for the whole year to date, we're down 2.4%. So I think, again, we're beginning to see some things change at that fed cattle level in terms of what's going on in feedlots and subsequently for slaughter and beef production. So total cattle slaughter for the year is down over 4%. And these numbers keep getting a little bigger in terms of the decrease year over year each week. Again, as I said, last year beef production didn't decline. Fed slaughter or fed beef production actually went up. Non-fed beef production was down because of the reduced cow slaughter. I do believe at this point, I got the numbers here. This table says that for 2025 we're expecting upwards of a 2% decrease in beef production. I think we might actually be over a 2% decrease before it's all over with. We didn't drop last year, but I do think we're going to move into reduced beef production for the rest of this year and for next year as well. At least through 2026, I expect to see reduced beef production as we sort of again, deal with the reality of the fact that we just don't have the feeder cattle to maintain beef production in the short run. And of course, the other meats here, we're really talking about very little change in terms of total production of pork and poultry. So, on net, we're going to see a slight tightening of total meat supplies in the country, but most of the action is really happening in terms of year-over-year changes in the beef market at this point in time. Up till now, we have seen just phenomenal demand as reflected in the wholesale beef price. We'll look at retail in just a second. And in fact, in the last week, and I think it's related to the fact that slaughter and beef production have dropped pretty sharply in the last 7 or 8 weeks, we've seen about a $10 increase in the choice box beef cutout just in this past week. And so we've really seen a sharp jump here. Now, the cutout value tends to go up and peak seasonally a little bit earlier than this and come down through the summer. We may not see as much of that, although I wouldn't be surprised if it doesn't flatten out here as we get into the heat of the summer. Typically, the summer doldrums kind of dampens wholesale markets a little bit. Retail beef prices, we just got the new monthly data for May, and we see a slight decrease from the previous month in the all fresh beef price, but we're still up here at record levels. Again, it's summertime. In fact, this decrease was at the same time. No, not that one. But typically, we do see retail prices again pull back a little bit once we get past Memorial Day and really ahead of July 4th, going into the heat of the summer. We'll see a little bit of decrease in that seasonally. But there's no indication that beef demand is weakening at this point in time, even though we are essentially at record levels. We continue to see extremely strong markets for most of the wholesale cuts for both middle meats and end meats actually have been very strong as well in the last 2 months or so. A couple slides on trade, and then we'll come back around and finish up with the cattle cycle and where we go from here. Beef exports in the U.S. peaked in 2022, dropped pretty sharply in 2023, and we expected that as we got into these high prices and tighter supplies, broadly speaking. It didn't decrease much in 2024. And of course, now in 2025, we've had massive changes politically in terms of trade arrangements and all kinds of uncertainty there. So if we look at so far this year, we've been down. And I think, the April data we just got reflects a little bit of that, but there's probably a lot more volatility and uncertainty in these markets going forward. So it's going to take a while, but I do expect to see, the impacts of that in these export markets. You can go market by market and see some things already, but there's probably a lot more adjustments to come as these all of the tariffs and all of the changes in the tariffs and the trade agreements that we're either have or trying to make or whatever will put a lot of dynamics and a lot of volatility in this market for many months to come, I expect. On the import side, again, we did see a sharp jump in imports last year in response to our tighter non-fed beef supplies. Most of this, the majority of this, I should say at least, is in fact processing beef, largely for grinding. So we saw big jumps last year in Australia, who has recovered from earlier problems. They were very low for a couple of years simply because they had domestic production issues. They've recovered, and we saw a big jump there. We saw a fairly big jump in Brazil. And then Canada and Mexico and New Zealand continue to be the other part of our top 5 markets here. So far this year, imports are up sharply. And in fact, in April, I think they were up about 45% year over year. And so again, we're seeing some of this is dynamics related to all of the political stuff that's going on. Some of it is just in response to the fact that domestic supplies in the U.S. of this type of processing beef are extremely tight. And, if you look at wholesale prices for lean 90% trimmings that would form the backbone of ground beef markets, those prices are at record levels. And in fact, we're pulling in not only more imports, but we're also pulling in meats into the grind. We're pulling a number of things that we have not seen before just because of the fairly dramatic decrease in that non-fed beef supply that's available in the U.S. Need to talk just a minute about live cattle trade because of the issues going on, particularly with Mexico. Last year, we imported about the same number as the year before. And that was despite the fact that we closed the border in November for the last 5 or 6 weeks of the year. And then we did open it briefly this year in February, started to bring cattle back in more or less on a normal basis, although not quite to normal levels. And then May 11th, we closed the border again, and it's likely to stay closed now for an extended period of time because of the the continued issues with the screwworm fly in Mexico, New World screwworm. It's going to take, I think, a very concerted effort for quite some time in order to demonstrate that we've got any control over that. So the U.S. is working with the Mexican authorities, but it already basically got away from where we had the best chance to control it. So now it's going to be a much harder battle to control this thing going forward. And certainly along the border areas of the U.S., there is at least certainly a reasonable risk that we might see it actually get to the U.S. It's still several hundred miles south of there at this point in time, but I can tell you for a fact that in Oklahoma, Texas, and some of the other border states that lots of things are in place to begin surveillance and monitoring for the possibility that we could see this. Canadian cattle, I really don't have anything to say about this. It's more or less business as usual. The tariffs are having some impact this year. So we did see a drop in Canadian cattle imports. The live cattle trade with Canada is a more diverse set of cattle. It's fed cattle mostly. That's what the blue part of this is. These go straight to packing plants. The red part is cull cows and bulls that also go straight to the packing plants. And then the green part would be feeder cattle and a little bit of breeding animals that come in. The feeder cattle go into U.S. feedlots for finishing before they go to slaughter. Okay. So last bit, switching gears one last time here. Here's another chart of the beef cow herd. This is really the basis for, herd rebuilding and the dynamics and overall beef production in the industry. So, here's what we did. The yellow shaded areas represent cattle cycle expansion periods. And so the last one is a good model in terms of what we did. We went from a low in 2014 to a peak in 2019. We did that very rapidly, it turns out, with the benefit of hindsight in particular. So here we are, lower than that. Maybe this is the low. We don't know for sure. But, if you look at what happens to turn this around from the low and grow, you have to do a lot of heifer retention. That's the blue line. So heifer retention went way up in 2015, 16, 17. That was the basis for the herd expansion, combined with very low cow culling rates. And so we start screening those cows more heavily. One man might cull them, but his neighbor might take a cull cow and see if they can get another calf out of her in this kind of market, given the values that they have. And so what we're seeing right now is that cow culling is coming down. And in fact, it looks like it will be at a level by the end of this year that would be kind of consistent with the idea of herd rebuilding. But if you don't have the heifers, it won't work. And heifer retention has not turned up yet. Now, again, I think some of it is happening. We won't get the data to confirm that for several more months. But if we are starting, it's a fairly slow process. This really shows what the difference is. The green bars is what replacement heifers were doing prior to the beginning of herd expansion in 2014. The blue part was back in the 1990s. And what the chart says very simply is that in both of those cattle cycles, we started saving heifers and building heifer supplies, replacement heifer supplies, prior to the beginning of herd expansion. What we've been doing with the red bars here, what we've been doing the last 3 to 4 years is we've been depleting heifer supplies. That's that big heifer on feed number that we saw earlier. We've continued to use heifers on the feeding side rather than on the breeding side. So we have no pipeline of heifers. The supply of replacement heifers, both bred heifers and heifers that we were going to breed this year, came into 2025 at record low levels. And so we simply don't have the supply of cattle. If cow slaughter falls enough in 2025, we might have enough bred heifers in the pipeline at this very low level to at least stabilize the herd size for the year. Possibly fractionally higher, but very, very limited. And even for next year, the prospects for herd growth are pretty limited. We didn't bring in a lot of heifer calves that were in development to breed in 2025 for 2026. We probably are breeding some extra heifers out of the residual pool of feeder heifers that are out there. We always do some of that, and I think we're probably doing a little bit more of that this year. But all of that to say that the herd can't grow in 2025. It might grow just a little bit in 2026, but it really depends on what we do now. If we start saving heifer calves in 2025, we can breed them in 26, they calve in 27. We're talking 2028 before we start really impacting beef production. So, and in the meantime, in order to do that, we're going to be pulling these heifer calves out of that feeder supply. So the tight supplies of feeder cattle that we currently have are going to have to get tighter, and that's going to continue to support this market at least for a couple of years and probably a bit longer as we go forward. So we got to rebuild female numbers. We're starting really slow. We're already a year later than I thought we might see some attempts to rebuild the herd. We've still got drought threats in some parts of the country. Financial recovery probably has happened a lot. A year or two ago, that was a big deal because everybody had been impacted by drought so much. But I think now we've continued to sell heifers and feed them and take advantage of their value for that. And now I think producers, where they can, are beginning to think about a little bit longer term view of those heifers' value as an investment in future production, not just the immediate market value that they have. So the bottom line is that cattle prices are at record levels, and I expect them to go a little bit higher. They may kind of start to plateau here. I don't know that I expect them to go up as dramatically, but the peak in prices is not in 2025. It might not even be in 2026, although we could see the peak. But in any event, I don't think we see a sharp break in this market for the foreseeable future. Again, it might be out towards the end of the decade before we see enough change in production that could really result in substantial pressure on the market. So cow-calf producers are in the driver's seat right now. These calf prices are all about trying to incentivize herd rebuilding. And so that's where the market focus really is. Everybody above that level, feedlots, stocker producers maybe, and feedlot producers, packers, all of the margin operations above the cow-calf level are struggling a little bit with these margin squeezes that are going on. Packers have really been squeezed. They've borne the brunt of that up until this point. But as we go forward with even tighter feeder supplies, I think feedlots are going to begin to see more of that squeeze as well. And eventually it'll even reach the retail level. We'll probably push retail prices a little bit higher before this is over. But at some point, I think retail margins will probably also absorb part of that margin squeeze more than they have up to this point, because we've had adequate beef supplies up to this point. That's going to change a bit over the next couple of years. So I think we've said all this. Herd rebuilding hasn't really started yet. Maybe it's just starting. It's a slow process. Margins are strong for cow-calf producers, but more variable for everybody else, a little bit more challenging. The supply fundamentals are supporting higher prices and are still extremely strong, and will in fact get tighter and more strong as we go forward. And as long as demand hangs in there, then it all works. It can play out. The volatility in this market is pretty scary, and most of that's external to the cattle industry. Internally, the cattle industry is pretty bulletproof. There's just not a lot can change those supply fundamentals enough to really change the underlying story here of what should happen. Externally, all kinds of things can happen politically, geopolitically around the world, macroeconomics. All of those things could affect, and of course, with all of the dynamics in the trade side, we're going to see some impacts that could change it slightly. I don't see it changing the overall outlook that I have right now, but I do see the potential for lots of short-term impacts on producers, lots of volatility. That means that producers really need to still do risk management. Even if you're bullish on the market on average, you don't sell on average, you sell at specific points in time. And we're certainly subject to a lot of short-term uncertainty and volatility in this market. And so it's important to sort of pay attention to those marketing windows that you have and take some steps to try to protect those, or be prepared to wait them out. Most of the volatility has been relatively short-lived up to this point, and would be unless we have some really massive thing that would completely change the picture for everything and everybody. With that, I'm going to stop. I don't know if we have any time or interest in doing questions, but I'm certainly willing to.
Any of you guys have questions? Any questions? Okay, looks like we don't have any, but thank you for going through your presentation and taking the time to talk with us, especially with how this started out, but.
No, it's all good. I'm happy to do it. Hope you can get some use out of it.
Thank you.